Good evening, everyone, and a very warm welcome to today's PMS Bazaar webinar. We are delighted to have you with us for an insightful session on the topic Auto-Adaptive Strategies for a Rapidly Changing Market. I am Arvind from PMS Bazaar. In today's world, markets are more dynamic and unpredictable than ever before, and traditional investment approaches may fall short. This is where auto-adaptive strategies play a critical role, helping investors navigate constant shifts by blending research, data, and agility. Over the course of this discussion, we will be decoding what auto-adaptive investing really means and why it has become so relevant in today's environment. A special focus will be on the Alchemy Smart Alpha 250 strategy, which uniquely combines the strength of quant with the experience of active investing. And finally, we will gain insights into the eQGP framework, a powerful model for building adaptive portfolios. For that, we are privileged to have our distinguished speaker, Mr. Alok Agarwal, Head of Quant and Fund Manager from Alchemy Capital Management, who will share their perspectives, frameworks, and practical insights on this exciting approach to investing. Mr. Alok comes with over 22 years of rich experience in the field of equity fund management, and he is currently part of Alchemy Capital Management. Before joining Alchemy, Mr. Alok had an illustrious career at PGIM India Asset Management, and his professional journey also spans across well-known institutions such as Deutsche Asset Management, Choksey Securities, the Tata Group, and Pinnacle Academy, giving him a wide and diverse exposure across different facets of the financial markets. Academically, Mr. Alok holds a Chartered Accountant designation along with the CFA and CMT charters and also a master's degree in commerce and finance. Beyond his professional life, Mr. Alok is also an avid marathoner. Welcome, sir, and I would like to hand over the forum to you for your presentation.
Thank you so much, Arvind, and good evening to all of you who have joined in. I'll try my best to make the session a fruitful one. The topic for today's discussion is a very valid one, that is an auto-adaptive strategy for rapidly changing markets. We all wish that there was one particular formula or one line or one kind of stock that you screen this and you get the winning stock and you keep performing and outperforming. So that's a wish that is seldom true and doesn't come true really. So we need to keep evaluating the markets. We need to keep assessing what kind of situations and cycles we are in and accordingly adapt. And those who adapt, they actually perform well for a longer period of time. I often take the example and my anecdotes, a lot of them from the cricket field. So we know the master blaster Sachin Tendulkar, and he would play differently when it's a T20 or a one-day match or a test match. So he could adapt to the changes, and that's where he had such a long, illustrious career. So keeping those things in mind, the start of today, one particular slide that I had to share with you all to show that how things change over a period of time is here. What I've done here is I've divided the market into various sectors and grouped them also. So financials, cyclicals includes these 6-7 names like materials, industrials, energy, utilities, communications, and real estate. Consumer includes both discretionary and staples. And then there are other differences like IT and healthcare. Let's focus initially. Imagine we are going past in time machine and we are at the end of calendar year 2003. Out of, if 100% is for the overall market, how much was there for financials? It was only 19%. The cyclicals, they were dominating. They were nearly 41% of the market. The consumers were again around 19-20%, and other differences were at 20%. Keeping these numbers in mind, understand that from 2003 till 2007, this 4 year was a kind of a bull market that possibly we have not seen in any other time in history. And this was a capex-led recovery or capex-led rally in the market. Very important to understand, if it's a capex-led rally, you got to be on the side of the market. We cannot fight the market. So our topic was auto-adaptive strategies for rapidly changing markets. If the markets are rewarding, if the markets are conducive for capex-oriented plays, they are likely to do much, much better than the overall market. How do we know that? See, between 2003 to 2007, in the interim period, Sensex went up 7 times. Roughly in 2003, it was 3,000. And roughly towards the end of 2007, it hit nearly 21,000. From calendar year to calendar year, it may not be 7 times, it could be 6 times also. But which sectors did well? In a rising market, financials from 19% became 15%. Fair enough to say that they may have done well in absolute sense, but at least they did not outperform the markets. Imagine cyclicals. Cyclicals went up from 41% in 2003 till about 67%. That's a huge number. So imagine if I'm saying that the index went up, say, 6 times also. So if the index was 100, in 2003, cyclicals was 40. If 100 goes to 6x, that is 600, the 66% there means the cyclicals went to 400. So from 40 to 400 is almost a 10x at a sectoral level. We cannot afford to miss such big moves in a period of time. The sector that is leading the rally, we cannot miss that out. Look at this, what happened to the consumers. From 19.6%, it went down to 7.7%. So it's literally less than half during this period. It's not that the stocks corrected. It's just that they could not participate in the big rally. Other defensives like IT and pharma also became half. So if you notice, out of the 4 groups, 3 of them did not do well or did not outperform. It was a cyclical driven rally. So if at that juncture, during this period, somebody would have been underweight on cyclicals and overweight on rest of the stuff, would have really caused a lot of pain. Because we keep hearing that there are certain strategies that say that we do not invest in infra or we do not invest in cyclicals. Or sometimes they say that we do not invest in high value consumers. Those things, they may work for a shorter period of time, but as investors, to be successful, we need to understand what cycle we are in. Suppose at the end of 2007, because of a 10x move in cyclicals, if suppose somebody would have taken a call that no, financials and consumers don't work, look at the history, it's a cyclicals that works, and hence we will buy only from cyclicals. But markets can throw surprises. Now let's compare from 2007 till 2019 calendar year end. What happened during this period? The financials from 15% went to 38% nearly. They were the ones that led the rally. Cyclicals this time halved. Imagine somebody that was leading the rally in the previous cycle is such a big underperformer. From 67 becomes 31%. Consumer again more than doubled. Other defenses also increased. It's absolutely the opposite of what happened in the previous cycle. Earlier, only cyclicals outperformed, others underperformed. This time, cyclicals underperformed, others all outperformed. If somebody would have got this exactly wrong, it's like whole 16 years gone. So it's very, very important to keep adapting and to keep understanding what changes are happening. From 2019 till now, I'll skip this column. From 2019 till now, so far, we are seeing financials again losing their weightage. Cyclicals are again back. Consumers maintaining their defenses have increased. It's only the financials that have lost, but the cyclicals have made a big comeback. Does this mean that this cycle belongs to cyclicals? The answer is so far, yes. Does this mean we should be in cyclicals? All that we discussed today is only for understanding purpose. We are not going into any kind of recommendations because we don't know the future. We just understand what has happened in the past. But please understand what we're trying to convey here, that you need to follow and understand what kind of business cycle, market cycle, economic cycle we are in And accordingly, instead of fighting the cycle, be on the side of the cycle. So that's what auto adapting is. So as and when we see the changes happening in the sectors, we need to be aligned accordingly. Before I go delve further into the Smart Alpha 250 and the eQGP framework, there's one more factor slide that I got for you. There are very nicely few factor indices that have been introduced by the exchanges. There are momentum indices, alpha indices, quality indices, and value indices. All I did was I took out year by year, calendar year, which was the best performing one, which was the worst performing one. But the answer did not lie into one factor. If you go reverse, in 24, the best one was alpha, right? But in 23, the best was value. If I would have said, okay, 23 best was value, let me stick to value, 24, it did not perform well. You know, what does well in 1 year may or may not perform very well in the next year. So it is not that that what factor is doing well, we should pick up. It keeps changing from time to time. And how do you adapt is the key. Briefly, I'll just touch upon the current scenario in the markets. The markets currently are, I've just got 3 slides for current market situation so that we know that before we go into our framework. Firstly, our current markets are characterized by slowing growth. This is Nifty 500 companies' growth in the last few quarters. See from a growth rate of 52, 44, 28, 15, see what has happened in the last 5 quarters. 4 quarters of single-digit growth. After 4 straight quarters, after this is the 5th quarter that we had a 10% growth at least. But if I divide the Nifty 500 into large, mid, and small caps, look at the larger caps. While the stocks may be doing better, especially led by Jan and Feb of this year, but look at the earnings growth of these last 5 quarters of the top 100 companies. They are failing to touch even the double-digit mark. Now you'll understand that why possibly FIs are selling, why possibly India is underperforming, because if your valuation is high and the growth don't come through, this is what happens. But look at the mid caps. Out of the last 5 quarters where the large caps struggle to touch double digit, 4 out of the last 5 quarters, they have been handsomely in double digits. But that doesn't mean I'm talking positive about a particular market cap or something. Look at the small caps, 4 straight quarters of, again, very, very low growth. So we need to understand where the growth is coming from. And if the corporate profits are growing at a pace which is faster than the nominal GDP growth rate, historically, in such phases, the markets have done well. In India, historically, the nominal GDP has grown in the double-digit mark. Currently, also, we are close to that 10% mark. But the corporate profits, despite being slow, are growing at a faster pace than the nominal GDP. Look at these pictures that I've drawn. From 2003 to 2008, this ratio went up from 2.7 to 5.2. And it was during this period, we had that fantastic bull run wherein Sensex hit from 3,000 to 21,000. So when this was rising, this ratio was rising, the markets also did very, very well. But from 2008 financial year till about FY20, this ratio kept on falling. We understand that FY20 was characterized by COVID, but if you notice, throughout this 12-year period, it kept on falling. And during this falling period, actually the Sensex and the Nifty did almost nothing. For a 12-year period, the returns were very, very small. From 20 onwards, this ratio has again started climbing. We have again gone back to 4.7%, which is possibly the highest in the last 15, 16 years. And this number is extremely important. So if this number keeps rising, our expectation is, and the Bloomberg consensus estimates also talk about it, that this number is expected to rise further. And as long as that does further, the markets are generally more and more buoyant. The last bit about the markets and economy, the GST collection numbers, I've drawn month by month reported numbers from April 23 till about May 24, consistently in double-digit growth. But thereafter started the main issue that, especially if you notice this period of September to December of last year, 4 straight months of single-digit growth. And we all know that the markets peaked somewhere around August, September 24. So there was a slowdown in the economy, there was a slowdown in corporate earnings. But post that, once the government realized, and initially with the direct tax cuts, and very recently with the GST rate cuts, of course, these numbers may actually go up. We need to really wait out and watch because this is the real barometer of the overall economy. So the overall economic picture kind of shows that there was some kind of slowdown, but because of the government action, there could be some kind of recovery in the growth numbers. The things that we spoke about and the need to adapt, we also faced when we saw multiple strategies, funds across the world, that things that are at the top in a particular year or two, they fizzle out in the upcoming forthcoming years. And one of the main reasons I usually found is that those who could adapt to the changing market realities, they continue to remain in the top ranks. Those who couldn't, they fizzled out. The auto-adaptive strategy is the hallmark of this particular fund that we run, that is Alchemy Smart Alpha 250, which the whole idea here is to adapt to the changing market cycles and accordingly position the portfolio by investing only in the top 250 companies and thereafter being a little more consistent in delivering that alpha. That's the objective of the strategy. So I spelled out a lot of things here that by investing only in the top 250 companies, I want to adapt automatically and yet use a lot of rules and cons to it so that the emotional biases do not come through and yet outperform the markets more consistently. So when you have such a diverse, such a stiff problem set in front of you, you need to have a very solid framework to ensure that you'll achieve that. The framework that we created for this, our proprietary framework, we call this eQGP framework. More than the name, now let's go deeper into this framework. To understand this better, let me put this way, that this framework evaluates every company through three different lenses. So if I have those 250 companies in my universe, each of them will be evaluated for a host of variables while analyzing them. But instead of listing all the variables, I categorize them into three parts. The first part is the test for its quality, where a score out of 100 is assigned on the basis of multiple variables on which it is evaluated. The second is the test of its growth. Again, a score out of 100 is given. And the third is the test of its price action, because ultimately only when the price moves, I'll get those returns. I'll go into the deeper analysis as to what variables go into this. But let's understand the overall framework first. So if a company has a score out of 100 for quality, a score out of 100 for growth, and a score out of 100 for price action, so every company has three particular scores. So my 250 companies, which is my universe, the top 250 companies by market cap. So 250 companies will have 750 scores. But in order to compare companies, in order to rank companies, I need to have an overall score. Until unless I have one score for every company, I will not be able to rank them because some companies will be good in quality. In order to come to a particular one score for a company, the easiest method would have been that I have the three scores. I should take a simple average of the three scores and I get a composite score. And it is exactly at this point which becomes the differentiating factor of this strategy. Because mathematically, if I take a simple average of the three scores, I'm indirectly giving equal weightage to quality, growth, and price action. And if I give equal weightage to quality, growth, and price action, how am I adapting to the market cycle? So it is first important to understand what kind of market cycle or market environment we are in. That's why I introduced this variable E. And basis the market environment, decide whether to give higher weightage to quality or to growth or to price action. I hope I'm clear till here. Now we come to analysis of market environment. Before I go into the variables as to what goes into deciding, let's understand how am I going to use it. In cricket parlance, market environment is almost like studying the pitch report. The pitch report studied by the captains, they try to assess that in a 50 over match, is this a pitch for a 200 score or a 350 score? Whether they want to play aggressively or defensively. That's a key that they want to understand from a pitch report. In environment, which is a study of not the stocks, it's a study of the markets and economies. It helps me decide whether to be aggressive or not. I've made it look like a speedometer or a riskometer. When the needle is in the middle, it's a neutral zone. As the needle moves towards the right, this market is becoming strong, stronger, strongest. As the needle moves towards the left, the market becomes weak, weaker, weakest. So it is not just a binary black and white, strong and a weak market. So like in a car, if the car is at 50, it is a neutral. If it goes to 60, it is moving fast. At 75, it will be moving faster. And at 90 or 100, it is really the fastest. So the speed keeps increasing. The idea has been, so as the market becomes more and more stronger, one has to be more and more aggressive. That's the logic I have used here. So if the market is weak and very, very weak, it is not conducive for a very aggressive kind of a style. One needs to be more and more defensive. So what I do here to understand that is, if the market is strong and I need to be aggressive, I have decided to keep higher weightage to price action, followed by growth, followed by quality, in that hierarchy. So if you notice this dark brown band, which corresponds to price action weightage, which can be loosely called momentum-based factors. So as the score goes higher, can you see this band becoming wider and wider? So that means as the market gains strength, there is far more role of momentum to be played rather than fretting over the quality. Again, I take that example of cricket match. We often see Surya Kumar Yadav hitting a shot behind the wicketkeeper's head. It may not be entirely the greatest of a textbook quality shot, but if that gets you few runs and if got a lot of runs towards the slog overs, in the slog overs, that's what matters. But yes, when you are 5 wickets down for 15 runs, it's not that kind of shot that you're looking for. Then you're looking for some real quality batting. It's almost like that. You adapt in this markets as well. So coming back, as the market gains more and more strength, the weightage for price action goes up. Also look at this orange band. The weightage for quality keeps going down. It is never zero, but keeps going down. If I were here at 100 and the market keeps losing its strength, look at the way the quality's weightage is rising. This is the midpoint again here. Keeps rising. So the weaker the market, higher the weightage for quality, because I'm adapting to be more and more defensive. I'm not predicting in this model whether the market will be defensive or be strong or be weak. But as the market stance is, I take decisions accordingly. I hope this is clear because this is the most differentiating factor of the strategy. I'll come to the portfolio construction and throw some light on the variables that go into the each of those categories as well. As I explained, I just look at the top 250 companies by market cap in this country. And each one of them, as we were explaining, are scored for their quality parameters, growth parameters, and price action parameters. How much the weights will be assigned to them to mix them, that depends upon the environment score, as we just saw in this meter. Once I have the scores and the weights in step 3, all I need to do is multiply them. Multiplying them gives me the weighted average score for all the companies. Once I have one score for every company, it's easy for me to rank them. Top 25 companies go into the portfolio. That's how the portfolio is started. We rebalance this on an ongoing basis to ensure that the best companies, the strongest companies remain in the portfolio and the weak ones are culled out. Our process is quite similar to gardening, where you bring the saplings, you sow them, you take care of them, nurture them, but while watering them, while manuring, giving manures as well, you ensure that You enrich the plants and the flowers, but you actually pluck out the weeds as well. So exactly that's what we do. While the better performing names, the higher weighted average score names are nurtured in the portfolio, the weaker ones are taken out for rebalancing so that the portfolio continues to remain strong. That's the process. I'll throw some light as to what goes into this construction of variables. Environment, as we were talking, as I was saying, it was a study of economy and markets. It is not the study of stocks and sectors because it's a pitch report. So here, while there are huge number of variables that we take, but I've listed down a few for your understanding. The most important one and the highest weightage is given to liquidity conditions in the market. This liquidity conditions is not what the FIs and DIs are buying or selling. It is the central bankers induced liquidity. The logic here is that if the central bankers in the world are printing money, there will be more money chasing the limited stocks and risk assets, and hence the value for risk assets can go up. The reverse is also true. If the central bankers, instead of printing money, are selling bonds and taking out the liquidity, that could be negative for the risk assets. This is the most important one, and in a lot of studies in the past, this has the highest correlation with how the markets work. Interest rates, as we all know, falling rates and expectations of falling rates is generally positive for the markets. Macro growth, again, rising growth and improving conditions and upgrades in the growth numbers are positive for the market, otherwise they're negative. Balance sheet wise, if the fiscal deficit, current account deficit, etc., for the country improves, then that's positive. But if it deteriorates, it's negative. This is an important one, price action parameters in multiple sections of the market. If I divide the market asset classes into two parts, the bullish risk-on ones are equity and cryptos, and the risk-off ones are gold and bonds. Currently, apart from India, but if you look at globally, equities and cryptos are rising. But in the case of risk-off, while gold is rising, bonds are not rising. So within these two, actually currently it's little more on the risk-on side rather than the risk-off side. Trends in corporate profits, we just saw that corporate profit to GDP ratio was rising, which is positive. But had we been in that zone of 2008 to 2020, this would have been falling. Currency situation, if it is stable, it is positive, but it is not stable currently. We have seen how the currency, in our case, has depreciated of late, so which becomes little negative in this particular parameter. And policy level support, the more the government is supportive of growth, etc., the more positive this number would be. We have seen that through direct tax, through GST rate cuts, through overall RBI involvement as well, by the interest rate cuts, the CRR cuts, and by ensuring that the liquidity is positive, the policy level support is quite good. So each of these are evaluated for positive, neutral, negative, and there are further set of variables as well, so that I get an overall score for the environment. It is seldom 100 or 0. Typically, it ranges from 20 to 80. When we come to these numbers on quality, growth, and price action, these are stock level evaluations. Most of these are very well-known numbers. I'll take a couple of examples as well. In quality, whether higher return on equity or higher return on net worth is definitely preferred. Lower leverage ratios are preferred. How consistently a company is generating profits and generating cash flows, both, they are very, very important. Apart from these objective numbers, the last number has a very high weightage, which is management quality. This is again, as I was saying, that this is a rule-based strategy, but also has an active involvement. Because management quality here, I try to rate as to whether the management or the promoters have been fair to the minority shareholders or not. This is something that has to be understood. This has to be felt and comes through experience, but it cannot be calculated. So that's a rating that on a subjective basis I give. Rest all are very, very objective numbers. But it's primarily to do with the efficiency of the business, the ability to earn more money out of the same capital. Same way, the growth is important. A company's growth is considered to be good if it is growing at a faster pace than its past, if it is going faster than its peers, if it is going faster than the overall market. So if you're faster than others, then it's important. When the whole market is growing at 15%, a 13% growth is not good. 18, 20 is good. But if the whole market is growing at only 5, 6%, same 13% growth starts looking very, very good. So it's all a matter of context as to where and how we are performing, what's the setup like. Price action, as I have been discussing earlier as well, it's loosely momentum driven factors. But when I say tailwinds in price behavior, that means I like to say that if the prices are rising, stocks have risen, that means there's strength in the price action. And I'm trying to evaluate that strength. So that's why I call it a loosely momentum based factors, but I've also written absolute and relative. So a rising stock is good, but that is not enough. It has to rise more than the market. So suppose in a year, the markets are up 30%, but a stock is up 25%. A 25% rally in a stock is not a small thing. It's definitely very good. It's a good momentum. But a 25% rally in a year when the market has rallied 30% is little of a dampener. So for me, not just the absolute momentum, the relative momentum also needs to be very good. Then I call this a very good price action. So that's what we need to understand. Then in ownership trends, this is the highest weightage in this factor. Ownership trends talks about what are the FIIs, DIIs, promoters doing about the company. If all of them are buying, there's something very important and good. If all of them are selling, there's something that we need to understand. There's been a couple of questions. I'll possibly take them once I just finish off this strategy presentation. I'll not take too much time there, and we'll have time for our questions. I'll answer each one of them. The consistency of outperformance also matters. And liquidity is one figure that's important. A lot of times there are stocks that do well in terms of returns, but there's hardly any share traded. So the volumes that can be absorbed there is important. So these are the four factors that I've tried to mix. Of course, there are a huge list of variables within that, but I wanted to give you the flavor as to how I have done. There is no one method that fits all. There can be multiple methods. This is just an example of the strategy that I'm using to adapt to the changing market realities. This is the snapshot of how the fund looks as of 31st August. So you'll notice that in the sectors, there are certain heavyweight sectors that are completely absent because either they are not great at, you'll understand all the inclusions and the ones that I've excluded, everything can be understood through the lens of that eQGP. And then it will be easier to understand and why certain sectors are not there or certain sectors are very heavyweight. You'll also notice that in the top 10 stocks, it is not at all mimicking any kind of index. It's on the merit of an individual stock. We saw initially that the larger caps were not growing much. The bigger growth was coming from mid caps. Hence, it is not really a surprise that 65% of the fund is allocated to mid caps. Few case studies for us. I've taken a few names here, but these are actual trades done in the fund. And please, by no means is this any kind of recommendation. These are actual holdings. Just for our understanding purpose, I have disclosed these. One of the stocks that was bought at the beginning of the fund itself, that the launch itself was Dixon Technologies, a leader in the electronic manufacturing. And we also exited that stock by May. But during this period, you can see the stock has actually delivered more than 3x returns for us compared to 37% growth in the indices. Again, the stock would have been picked up purely on the basis of the framework that I showed to you. Even now, the stock is great at quality, great in growth, great in price action. All three parameters, it's almost like a board exam. If you have three exams and if you're getting a very high score in each of them, you're likely to get into any good college. It's almost like that. It has to be evaluated. Similar thing we noticed in trend. We bought that again at the early on at the start of the fund itself. And this was also almost a three bagger for us in the fund, while the indices were up only 40%. A very interesting example is of BSC, because this is a stock that came in, went out, again came in. So in the first innings, we bought a stock in October, and within a span of say 7, 8 months, the stock went up 45% for us, and we booked profits because an exit came in because of the rebalance. But the biggest dilemma that I faced was I exited the stock in June. Within a period of 3.5 months, at much higher price, it appeared for re-entry in the fund. I can tell you with experience that for any fund manager, humanly, to sell something at a profit and to buy it back in 3 months' time at a much higher price is very, very difficult thing to do. Your psychology, your mind doesn't permit. But again, that's where the emotional biases are something that you need to overcome. And that's where the rules and frameworks help. I did that exactly. And so far, the numbers have been quite supportive in terms of the returns. They're still there in the portfolio. And again, I do not decide on the exit. It's a framework that decides on the exit. While most strategies talk about the entries and how certain stocks did well, for us, exits are as important as entries. We do track how did our exits perform after our after our exits from the fund for a period of 1 year. And we are happy to know that about 69% of the stocks that we exited since inception, after our exit, they underperformed the index. So that means not just our entries have to do well, actually your exits also have to do well. That's what helps. An example, in October 23, we bought Berger Paints, exited Berger Paints rather. In October 23, we exited Berger Paints. Look at it, what happened in the next 1 year, that the index is up 35, 36%, but the Berger Paints was down 4%. So by exiting, you avoided a 40% outperformance. But the bigger thing is, by exiting, you vacated a place in the fund. And coincidentally, that place went to Prestige Estates. Look at this date. And that stock over the period of next 8-10 months actually went up 132%. Imagine a minus 4% would have been there had this not been replaced. That got replaced with a plus 132. So your trade actually gives you plus 136%. And had I not adapted, or rather than model or framework not adapted and made those changes, again, then those performance numbers don't come through. So these were the things that I wanted to share with all of you. And now possibly we can have the floor open for questions.
Thank you so much, sir, for that insightful presentation and your cricket analogies. You have really helped us understand the nuances of auto-adaptive investing and how frameworks like the eQGP model can add real value, sir. I'm sure our audience also found it engaging as I did. Participants can now pose their questions in the Q&A box. So before moving on to the audience question, I have a few questions to ask you, sir.
Perfect.
So if we look at the performance of active large and mid-cap mutual funds, many have been able to consistently deliver alpha over their benchmark index. In such a scenario, investors often ask, why not simply go passive? So could you explain how your product stands out as a better way to invest in India's top 250 companies?
Uh, you know, the whole idea is around the compounding. The game of compounding is the one that's the most important one. And there's nothing against the passive, but the way things go, a passive fund ensures that your returns are slightly below the index, isn't it? Because they will be just copying the index. There is small management fee and small transaction cost. Typically, a passive fund's returns are around 0.5% below the index. By being auto-adaptive, if we can add those extra basis points to the returns, it makes a big difference. Just for discussion's sake, let's compare. Suppose the index returns are 15%. If we take an index fund, it would be 14.5% broadly. Some could be closer to 15, some could be closer to 14. But if by auto-adaptive methods, if you can add 5% to it, it becomes 20%. In percentage terms, these things look small. But if I were to say, let's assume, suppose we are 30s, 40s in the age. If we are 30 years ahead of us, 1 crore rupees at 15% for 30 years. Again, 1 crore initial value, 15% compounding for 30 years becomes somewhere around 66 crore. But the same 66 crore, if instead of 15%, if you're able to go to 20%, instead of 66 crore, you go well beyond 200 crore. Should we give ourselves a chance to convert our fortune of 66 to a 200 or not? If we want to give ourselves a chance, the way has to come through active, not through passive. But sometimes the logic used by passive is that in that attempt of making 66 a 200, we shouldn't be left with just 30-40. So my idea has been that it's a calculated risk. It has worked in the past. It has worked in the future, in the current times as well, and in multiple time frames. So it makes sense to make use of these strategies and give us a chance to make a fortune for ourselves.
Thank you for that perspective, sir. And that leads me to my next question on eQGP framework, which seems central to the strategy. The
Yeah.
eQGP framework you have developed is quite unique, sir, blending market environment, quality, growth, and price into an investing lens. Could you walk us through the origins of this framework, sir? What really triggered its creation, and what gap or challenge in investing it was designed to solve?
So what happened is I have been an active fund manager, typically fundamentally rooted fund manager throughout. And having spent nearly 23 years in the market, there have been a lot of learnings all the way. When I started off my career, from the books I had learned, buy low, sell high. That is the one I had learned. And anything that is cheap is good. So I learned that. But markets teach you a lot of things. And the experiences of others across cycles in multiple markets also teach you a lot of things. So all those learnings was put together in this particular fund. When we designed the overall framework, all the things that have an bearing on the prices and the returns were considered, not for the sake of it. So those that have had no particular bearing were kind of ignored. So I would say all the experience of so many years has been brought together and put into this strategy.
That's very insightful, sir. Now I would like to go deeper into that with the specific aspect you touched upon. You mentioned evaluating, improving, or deteriorating macro balance sheets. Could you elaborate on which indicators you monitor most closely, sir, and how they influence your allocation decisions, especially in a risk on versus risk off environment?
So let me explain. I'll go back to my slides and then you'll understand that a little better. So our question is a slide here. Yeah. So it was on the this one, fourth one, improving and deteriorating macro balance sheet. So now let's take one variable which is not counted here. Suppose that variable is crude. I have not written here crude. Just for sake, God forbid, but suppose crude goes to $200. Okay, just assume crude goes to $200. What happens to India? Inflation will go up.
Yes.
So interest rates cannot go down. Rising inflation, rising rates, negative for market. Growth numbers will start going down. Then comes a macro balance sheet. Our trade deficits go for a toss. Current account deficit goes for a toss. The fiscal deficit goes for a toss. The balance of payments become negative. These are the four indicators I look at in this balance sheet. So sometimes I have not noted the trigger separately, but all those things have a bearing on it. So, and if there is a deficit rising for the government, the last point is also a problem. They cannot give policy level support to the industries. So that's the key. To answer shortly, it's a fiscal deficit, current account deficit, trade deficit, and balance of payments. If those four are the key ones.
So macro signals act as a compass for your allocation, I think.
Yeah.
But when it comes down to the company level, management quality often makes or breaks the investment case itself. And that brings me to my next question. How do you assess management quality within your framework, sir? Is it primarily qualitative like governance and integrity, or do you also rely on quantitative KPIs? And more importantly, how do you ensure consistency in evaluating this across different companies and sectors?
So this is a very valid question. When you see management quality I've divided them into three parts. First is ability to generate profits. that can be computed in your ROEs, in your OCFs, in your EVAs, in your debt equity ratio. Those are objective numbers if they can run the business well. The second, so I don't judge on that basis. That part is already covered objectively. Then is the second part. The line of business you are doing, is it a good line of business or bad line of business? I don't want to judge that. Say, for example, suppose if I'm a non-smoker, a company investing in cigarettes or in, say, liquor or in, say, casinos, if I try to start judging as to these are good or bad businesses, then it becomes more and more difficult for me. For me, it's important that you're doing something which is legal, right? So some companies, so it's for me, I don't judge on that part. The key area when I write that management quality rating is, have you been fair to the minority shareholders? So the key deciding line for me is that a company or the management that intentionally hides material negative information from the shareholders, minority shareholders, these are the companies that I rate negative. So it's the intention that matters, it's your conduct that matters. So there are multiple examples over there. So that's what decides. So if you don't you don't cheat or double cross the minority shareholders, rest all is fine.
Got it, sir. So consistency and objectivity seem the backbone of your process. Now, one thing that caught my eye is the small cap allocation in your portfolio. I noticed that the portfolio has around 10% exposure to small caps. Is this something that emerged organically from your eQGP framework's output, or was it more of a conviction-based call, sir, from the team's broader market view?
No, actually, that's the statistical side because my universe that I defined for the fund is the top 250 stocks by market cap. But that is top 250 stocks by market cap as of yesterday. So when I invest, I see the yesterday's price. But when I report, I have to report on the basis of the AMFI classification of large, mid, and small, which comes twice a year. So, there's a slight bit of there's a good bit of overlap between the two, but my top 250 may not coincide exactly with the top 250 of AMFI. So while reporting, I have to go by AMFI standards. Otherwise, for investment purpose, I look at yesterday's market cap rankings.
Okay, thanks for clarifying that, sir. So, looking at your portfolio, I noticed that financials and industrials together form over around two-thirds of your allocation. Beyond the EQGP framework, what gives you such strong conviction in these two sectors, sir? And how do you view their future prospects?
So as you know, when this is the outcome of the process, right? So the process decided to do that, but of course, the the analyst in me, the researcher in me, would want to know further in it. And what I noticed here is when about 39-40% of the allocation was in financials, even my first observation was it is very similar to the index. But index is hogged by banks and NBFCs, and the lenders is less than 10% out of this 40%. I have only less than 10% lenders. The rest of the part is primarily into capital markets, the exchanges, the wealth managers, the asset managers, and some of the vendors towards these entities as well. So because those are the ones that are growing at a very, very good pace without much of a capital risk as well. Similarly, within the industrial space, the majority of the allocation is towards defense and power because these are the two areas that are growing at a very good pace. And a couple of aviation allocation is also there. So these are the areas that we are very positive on, and they're actually growing at a good pace as well.
Yeah, it's interesting to see how sector level conviction plays out in your allocation, sir. Now, moving from entry decision to the other side of the equation, let's talk about exits. The fact that nearly 69% of the exited stocks underperformed after your exit is quite remarkable, sir. So, why don't you tell us about the key factors or signals that drive your exit decisions? Is it entirely framework driven, or do qualitative and macro perspectives also come into play?
So at the outset, I must say it is completely framework driven. During the process, I said that initially the top 25 stocks went into the portfolio. Broadly, out of 250 universe, the top decile rankers went into the portfolio. Once you're into the portfolio, as the numbers keep coming out monthly, quarterly, etc., the ranks may go up and down. Just because a rank of a portfolio stock goes from 25 to 26, I will not exit that stock because otherwise I'll keep trading every day. It's not a trading portfolio, it's an investment portfolio. So if a stock goes down its rank from 25 and maybe 26, 27, etc., there is some buffer that I allow, some breathing space that I allow for the stocks to lose ranks. So as long as they are not going below my buffer number, below my threshold, they are kept in the portfolio. But if the rank of a stock goes below my threshold level, that stock is asked to leave the portfolio. Whether that happens because of its fall in quality, or because of its fall in growth, or because of fall in price action, or maybe just change in environment itself, I wouldn't know that, and I don't give interest to that. The most important deciding factor is that the rank of the stock breached the threshold level. That's it.
That's very clear, sir. Exit discipline seems as important as entry decisions.
Yeah.
So I think, Alok sir, if you are okay, we can move to audience questions, sir.
Perfect. Let's go.
Yeah. I think Mohit sir has already answered almost all the questions, but I will pick a few good questions, sir. So HJ is asking, how do you see future of Indian market in 3 to 5 years window versus foreign markets?
So I would say Indian markets are extremely good, not just for 3 to 5 years. For the next 20, 25 years also, I remain extremely confident and positive about Indian markets. And I'm not saying this because we are born in India and we are Indians. The economic numbers also say that. The key number to look for when you're talking longer term is what is the dependency ratio? As long as the dependency ratio of a country has been falling, those countries have done well in terms of higher GDP growth, and which translates into higher returns in the markets as well. In 60s and 70s, Japan saw that. From 80s onwards, China saw it. From 90s, India is seeing it. And as per World Bank, the dependency ratio in India will keep falling for the next 20 years at least. So that's what makes me most positive. The sectors that drive it, the companies that drive it, the strategies that drive it, they may change. But the markets and the economy is very conducive for higher growth. And that's what makes me very, very opportunistic about it, very positive about it, not for 3, 5 years, but for 20 years. And in terms of relative numbers, we are the fastest growing nation. So fastest growing nation will always get capital. Not in, I can't say about shorter term, but will always attract more and more capital. So given the fact that last 1 year, India has underperformed emerging markets by over 30%, something that we have not seen for 20 years, makes it even more conducive in terms of timing that, possibly a relative underperformance is over. And this could be one of the best times to keep adding.
Wonderful, sir. So Venkatarana has asked a question, will you be moving your portfolio to domestic businesses oriented than exports with the heightened volatility in exports due to Trump's tariff announcements?
So what happens is, while I will not change directly because of this, how does the model capture it is more important. Now imagine, let's go through that same framework, quality, growth, and price action. Imagine a company whose export businesses are getting hampered because of the tariff. What will happen to its quality? Its quality is unlikely to change, may come down a little because its ROEs may fall. What will happen to its growth? Its growth will collapse or come down or get affected. At least it will not go up, the growth numbers will go down. The markets may react negatively. Markets will obviously try to factor in that and react negatively. So out of the three categories, quality, growth, and price action, one is almost same, that is quality is almost same or slightly down. Growth is majorly down, price action is majorly down. Isn't it safe to say your weighted average score will also come down significantly? If your weighted average score comes down significantly, your rank will also come down significantly. And if your rank comes down, if you're not in the portfolio, you're unlikely to be in the portfolio. But if you are in the portfolio, the chances are you're getting closer and closer to that threshold, if not already breached.
Understood, sir. So Hitesh has asked a question, what is the rebalancing period for this portfolio?
So you'll be surprised to note that I run this on a daily basis.
Wow.
So most of the strategies that I have seen so far, they have a cooling period of 2, 3 months or something, 1 month, 2 months, 3 months, sometimes 6 months. But I run it on a daily basis so that the actions are not too delayed. But at the same time, we do not trade daily. I must highlight it's not a trading portfolio because of the buffers that are there, my tolerance that is there.
Understood, sir. I think we have come to the end of this session, sir. The remaining questions we will share it with you so that your team can answer the audience directly.
Perfect.
Is it okay, sir? Yeah.
Perfect.
Thank
Thank you. Thank you so much. My pleasure being here with you all. All the best to all of you.
Yeah, thank you so much, Alok sir, for sharing your valuable insights with us today. The discussion on auto-adaptive strategy, research-backed frameworks, and the way Alchemy blends quant with active investing has given us a lot to think about in terms of how portfolios can be managed, sir, in this current environment. A big thank you to all our participants for taking the time for joining us. We hope this session helped you better understand the concept of auto-adaptive investing and the eQGP framework and how such approaches can add real value in navigating today's market complexities. We look forward to having you join us again in our upcoming webinars for more such engaging and insightful discussion. Until then, thank you once again for being with us today, and we wish you a wonderful evening ahead. Thank you, sir.
Thank you.